AI, the big wave you don't want to miss. In this video, I'm going to show you exactly how I made $129 for a 4-day trade, and I put up less than $1,000 in capital. Stay until the end because I'm going to walk you through my exact platform on Thinkorswim. I'm going to show you exactly the entry points, the risk involved, the rates of return. I'm going to show you everything, and I'm going to give you a special invitation at the end of the video. Now, what I'm talking about is cash secured puts. It might sound confusing, but it's super simple. Basically, you're committing to buy a stock that you like if it goes on sale before a certain date. If it doesn't go on sale, you don't buy the stock. Either way, you keep cash to make the trade. It's kind of like you're an insurance company. So someone else owns 100 shares of the stock that you like, and she's buying insurance from you. You're promising to buy her shares if the stock crashes. If it doesn't crash, you don't buy the shares, and either way, you keep the cash. This is literally like one of the safest strategies that there is. Listen, so many people out there talk about options being risky. They're saying that because they don't understand how options work. Options can be confusing if you allow that to happen. People talking about theta, intrinsic value, extrinsic value, trading spreads, straddles, strangles, iron condors. Oh my gosh, it doesn't have to be that tough. You only need to know 2 strategies, literally 2 simple strategies. Sell a put, sell a covered call. I'm gonna walk through in this video exactly how to sell a put and put cash in your pocket today. So I'm gonna walk through an exact trade that I made this morning on Tuesday on SMCI, Super Microcomputer. So I like this company for a couple of reasons. First of all, they are a multi-billion-dollar company. In fact, I think they're worth about $32 billion by market cap. The company was founded by Taiwanese billionaire Charles Liang. He has 5 million shares of stock options with a strike price of $45 that are directly correlated to the success of the business. The company has to hit certain revenue and stock hurdles in order for his options to vest. So he's directly incentivized to do an amazing job for the company and increase share price for stockholders. Now, let's look at the stock. It's literally less than $50 per share, and it's been going down lately. But don't be afraid of the stock going down. That just means it's going on sale. If you like a company at $50, you should literally like the company, if it's the same company, at $45, unless something has drastically changed, which it hasn't. Here's the thing, guys. Stocks go up and down all the time. That's not anything new in the stock market. And when stocks go down, particularly good stocks that you like, it presents an amazing opportunity to either sell puts, buy shares, buy more shares, average your cost down. You want to embrace that. Now, before I jump right into my trading platform, I'm going to ask you for a quick favor. Hit the subscribe button in the bottom right-hand side of the video. I'm literally doing a video each and every single day for 1,000 days, talking all about puts, selling covered calls, walking you through different tickers. Today, in case you're wondering, is day number 120, right in a row. Okay, let's jump right in. Okay, I'm gonna walk through this trade with you step by step using my exact platform on Thinkorswim. This is a chart of SMCI, Super Microcomputers. This is a 1-day, 1-minute chart. I'm always going to start by looking at where the stock has been for the past year. So we can see visually, okay, it's up, it's down, it's up, it's down, etc. That's what stocks do. Stocks go up and they go down. Now, SMCI is due to declare their earnings Tuesday, today, after the market closes. So typically, a handful of days before earnings, you have a lot of volatility. But as I've talked about before in prior videos, don't fear volatility. They can present amazing opportunities. Let me show you exactly the trade that I myself did this morning. So what I'm talking about is selling a put. Basically, you're committing to buy the stock, but only if it goes lower than a certain price before the expiration date. Now, typically, I only look at very short-term trades. Why? Because I don't want to tie up my capital for a long period of time. And secondly, I want to create myself income every single week. So this is a November 7th contract. You see the strikes down the middle. These are the prices at which you are committing to buy the shares if it drops below that price before the contract expires. Now you'll see here's my position here, marked by the red position mark. I sold a $45 put. Right now, Super Microcomputer is trading at $48.36 per share. So it has to drop below 45 in order for me to buy the shares. Now, you'll notice a couple of things. Number one, the implied volatility is super high, 154%. I like implied volatility. A couple of reasons. Number one, you get paid more premium for the risk that you're taking. And number two, because it's volatile, that means it goes up a lot and often, and it goes down a lot and often. So if I did have to buy these shares, I'm planning to turn right around and sell a covered call against them right afterward and make money again. This isn't about buying stock and hoping and praying that it goes up over some indefinite period of time. This is about creating yourself weekly income to change your life. Also, you'll notice this $45 strike has a delta of 28. What that means is it has an approximate 28% likelihood that it's going to drop below $45 before it expires. But I'm okay either way. If it doesn't drop, I don't buy the shares. And if it does drop, I do buy the shares. I'm totally fine with either of those outcomes. Now, I sold this contract this morning just a little while ago, and I received $129. You'll see it last traded at $132. What that means is you receive the premium dropped into your account right then and there. If and when the stock drops below $45 per share, you're agreeing to buy 100 shares. Now, if I didn't want to use margin and I wanted to sell what's called a cash secured put, I'd need $4,500 in my account to make this trade. Why? Because it's a $45 put and you're committing to buy 100 shares. Now let's calculate the rate of return on this particular contract. Although it's trading right now for $134, I sold it this morning a little while ago for $129. So I'm going to use that number and I'm going to show you exactly my trade, how much I made, how much I risked, and how that all works. And I'm going to walk through all of it with you. So we're going to divide $129, which was the premium that I made, divided by $4,500. Which is the amount of capital that you have to put up if you put up all the money and you don't use margin. Well, we can see our rate of return is 2.8%, but I'm literally holding this trade for 4 days. So I'm just going to be simple and I'm going to round off. I'm going to illustrate to you if you did a trade like this every single week. And believe me, guys, there are tons of trades like this each and every day all over the place. Just watch my videos. I walk through so many of them. So if you did a trade like this every single week, making this kind of return, you are literally making 149% on your money. Now, let me give you a bonus. That's the rate of return if you put up all the money, $4,500 to make that trade. But if you wanted to, you can also use what's called margin. Margin is using some of your money and some of the bank money. You know, I'm a big believer. Why use my money if I can use somebody else's money? Now, you have to be careful with margin because, for example, if the stock goes down significantly, you could incur a margin call, which means you either have to put more money into your account or your trade gets liquidated, oftentimes resulting in a realized loss. So margin does come with its own concerns. So you want to make sure you have enough capital to sustain your positions on an ongoing basis. Now, if you want to use margin, the way you would calculate it is this. You're going to click on the bid for the contract that you're interested in selling, and that pulls up a trade window. So you can see here, I'm selling one SMCI November 7th, $45 put, and I'm going to right click here and I'm going to analyze the trade. Now your margin requirement is on the bottom in the right here. So you'll see the margin on this particular position is $1,003. Now here's what I mean about margin. When I put this trade on just about an hour ago or so, the margin requirement was about $980, give or take. So the margin requirement does fluctuate as the stock price fluctuates. That's why you want to be careful and have care in how much leverage you're taking on your positions. But what I want to illustrate to you is the power of margin and the power of selling puts to create steady streams of income. Let me show you the rate of return on this particular trade. As I mentioned, I sold this contract for $129. So I'm going to divide $129 into the margin requirement, the capital that I needed to make the trade because I'm using margin. We're going to say $1,000. We're going to just round this off. I'm literally making almost 13% on my money and holding a trade for 4 days. If I did a trade like this every single week and used margin, I'm literally flipping my money over 6, almost 7 times over. Do you guys see how powerful options trading can be? Listen, guys, I'm not here to tell you, hey, you're going to make 100%. Hey, you're going to make 200%. Hey, this is a guarantee. That's a guarantee. Listen, there's risk in the market. You could lose some or all your money. Maybe this company would go bankrupt. What does that mean if it goes bankrupt? That means I'm out $4,500 because that's the contract that I sold, a $45 put. So there is risk, but what you want to do is you want to identify what's the risk, what do you think the likelihood of a scenario like that happening, and then you make a decision based on those premises. You can use option trading to create a side income for you, how would you feel to create yourself an extra $129 a week every single week and only have to put up, worst case scenario, $4,500 in capital? Pretty amazing stuff, right? Now, I really hope this video helps. It's my mission to help regular, everyday people just like you change the way they trade. Don't trade stocks and just hope and pray for the price to go up, only make money if it goes up, then you have to sell your shares. No, if you're doing it that way, you are literally doing it all wrong. Trade options, sell puts if and when you get assigned the shares of stock, then you sell covered calls. Create yourself income on a weekly basis. It's so much better than stock trading. If you like this video, smash the like button, subscribe to my channel. I'm literally putting up a video each and every single day for 1,000 days. I have a great live event coming up in a couple weeks. I only have a few seats left because I cap it at a certain number of participants. I'm gonna put the details in the comment section below. Also, feel free to drop a comment here. Let me know what you're trading. What's your favorite stock? Let me know what kind of stock you want me to walk through next. Anyway, thanks again for watching. I really appreciate it. Happy trading.